Hi, I'm Joel, Director of Capitalised Business Finance. This video is a general discussion about the different types of supplier finance, comparing features, costs and benefits. But firstly, just to let you know who I am, I'm an independent business financier who's helped many businesses achieve complete cash flow control through tailor-made financing solutions such as selective invoice finance, supply chain and trade finance, import finance and short-term business loans. Over the years, I've learnt a lot and seen many business owners make mistakes that have cost their businesses dearly. Mistakes that can be avoided by some basic understanding of how this industry works and what to look for when searching for a business financing facility. One of my goals is to provide the knowledge to empower other business owners to achieve success. The more positive, motivated, happy and successful business owners have in our society, the better all our lives will be. I'm also a property developer and investor, and I'm passionate about helping good, honest people succeed. I don't come from privilege. My parents came to our country with one suitcase of clothes and couldn't speak English. I'm self-made, and from personal experience, I'm a firm believer that everyone has the opportunity to be whoever they commit to be, but they must commit and put in the effort to succeed. So, let's get into it. Supplier finance takes many forms, from trade finance to supply chain finance to import finance. At Capitalised Business Finance, we offer these three types of supplier finance, but be aware that even within these types of finance, there are other variations in the marketplace. If you haven't already seen it, make sure to watch my video on what supplier finance is and the benefits of it. It's absolutely important to keep the benefits in mind when comparing these facilities because, as you will see, some facilities do not provide many benefits at all. Our trade finance and supply chain finance products are very similar. In fact, they utilise a common platform. Both facilities allow suppliers to elect, with complete flexibility, when they would like to be paid for their invoices, any time from the day an invoice is generated to its nominal due date. Other financiers will dictate specific fixed periods when a supplier can take payment, such as 14 days or 13 days from invoice date. As such, the supplier doesn't have the ability to effectively manage their cash flows, meaning that their business, and your business in return, doesn't benefit from an effective cash flow solution. These types of facilities are simply designed without much thought into the multiple benefits of suppliers being able to take payment as their business needs. They're low-quality solutions that are sold on price rather than function. In addition to the flexibility of deciding when to take payment, some facilities, such as ours, allow suppliers to select early payment only when they need it. That is, it's not an all or nothing approach where they either finance all of their invoices or none of them. Having to finance all invoices limits the flexibility of the facility for the supplier, defeating many of the benefits of supplier finance. If a supplier is forced to take all or nothing, and since most businesses experience only occasional cash flow gaps, it logically follows that in most cases, utilising these rigid supplier financing facilities can cost more to a supplier than utilising other forms of cash flow finance, such as selective invoice finance. If your suppliers are better off using another source of finance, then they aren't likely to utilise the rigid supplier finance option, and you will receive no benefit to your business from suppliers taking early payment. The key point here is that the more flexibility you can provide to your suppliers, the more likely they are to utilise the facility, resulting in better business outcomes for both your suppliers and your business. The best business minds understand that they are part of an ecosystem where all entities are reliant on each other for survival and growth. So helping your customers and suppliers improve their business will result in improvements in your business too. The best business minds always look for win-win-win outcomes. Targeting success at the expense of your suppliers and customers is an unethical path to failure. Aside from the supplier side benefits of increased flexibility for some financing products, there are also differences and other benefits and functionality for the client business. One important benefit and consideration is whether the supply finance facility requires some form of security and the resulting implications on the functionality. Our supply chain finance facility is a debt-free facility, meaning that we can offer the product to those businesses that qualify it without needing security. That is, the funds are off balance sheet. This facility focuses on the strength of the client business in order to provide the facility. So not all businesses qualify. But for those that do, having access to funds without tying up equity can be the difference between growth or stagnation. In contrast, our trade finance facility does require a form of security, but it also provides greater flexibility in functionality. If a business is seeking the benefits of a supply finance facility, but doesn't qualify for supply chain finance, then trade finance may be an option for them, with some other benefits included. Our import finance facility requires neither security nor directors' guarantees, making it a very attractive option for businesses that import goods from overseas. However, there are some requirements that must be met before a business qualifies for the facility. The key point here is that with the range of facilities available, we can tailor a solution to suit the needs of our client businesses. Another feature to consider is whether the facility allows the client business to extend terms, that is, pay the financier at a later date, on COD invoices, or where the supplier doesn't elect to take early payment. In other words, does the facility require the supplier to agree to the financing, that is, take an early payment, in order for the client business to extend terms to the financier? Owning a financing facility that limits your options based on the actions of your suppliers can be difficult and frustrating to manage. Nobody wants to cede control of their cash flows to a separate party. Facilities that allow you to extend to the financier irrespective of what your suppliers do provide much greater flexibility for your business than those that don't. Remember, it's not the fittest that survive, it's those that are best able to adapt. Flexibility is king. When a supplier takes early payment, they will settle for a small discount on the invoice value. It's this discount that provides the return to the financier and the client businesses. Often, the client business will be paid a rebate from the financier, a share in the discount that the supplier has settled on. The amount of the rebate varies from financier to financier, so depending on your motivations, you should find a facility that suits your goals. In some cases, the client business isn't interested in the rebate. Their motivation is the strengthening of their own business by strengthening their supply chain with a cash flow solution. In these cases, the client business can give the rebate back to the supplier, effectively reducing the cost of finance for their suppliers. In other cases, the client business will negotiate a higher discount than the rack rate of the financier and keep the increased discount for themselves. In these cases, the client business may have identified some suppliers who consistently seek early payment for their invoices, often offering substantial discounts. These suppliers are likely to be consistently taking early payment of their invoices, so the client business can aim to maximize the discount and automate the process by using a supplier finance facility. If this sounds a little unethical to you, then consider the fact that the supplier may eventually find that other finance options are a better fit for their business, such as selective invoice finance, meaning that the client business doesn't benefit from excess discounts for the long term. Again, I would like to repeat, the best business minds always look for win-win-win outcomes. Targeting success at the expense of your suppliers and customers is an unethical path to failure. We've seen that supplier finance facilities come in varied forms. Some facilities offer very little flexibility, while others offer a lot. From a consumer perspective, the simpler, less flexible facilities may appear to be cheaper, but as with any cheap financing facility, the true cost isn't realised until your business misses a large opportunity because of the inflexibility of your finance. Your business isn't an island. You rely on your suppliers and customers in order to prosper. So looking for win-win-win situations is the best long-term strategy you can follow. By selecting the right type of finance for you and your suppliers, you can increase your chances of success and better weather challenges that you will face. Finally, the supplier finance facilities I've talked about aren't typically quick short-term solutions to short-term issues. Rather, they're a form of longer-term finance designed to work continuously for the benefit of your business. As such, I encourage you to reflect on your business now, looking at your current and expected future needs, so that you have the time to find and implement the right solution for your business, not just the fastest solution. You've invested a lot into your business, so it makes sense to invest the time to finance it proactively rather than reactively. Thank you.